there. We're there as their finance department, so we're covering on the strategic finance side, the forecasting, the budgeting, the pricing, capital management, etc. On the accounting side, so we can also do the bookkeeping and the day-to-day transactional stuff. Valuations, we have a small valuations team, so when a company, a startup's looking to price their round, we can help with that. We can do the 409A valuation. And then the boring stuff, but very important stuff, the taxes, so we can help on the tax strategy, tax consulting, foreign filings, etc., the whole corporate tax thing. So that's us really quickly in a nutshell. I'm on the business development team. My background is finance and technology. I started in 2004 at some investment banks as a stockbroker. Then I did some investment banking at Morgan Stanley for a while. Spun off from the financial crisis, and then I got into tech ecosystems, ran a startup for a while, sold it off. And then I went independent, and I recently joined Early Growth about a year ago. So I'm just going to pass it to Amjad, and he'll take it off.
Hello, everybody. And thank you for having us here. Start out with a quote from our CEO, David Ehrenberg. So, you know, startup is a pretty daunting task, and I congratulate you all for launching all that. You know, you're involved in developing products, goods, and services. At the same time, you know, you need to really tackle with, as Anthony mentioned, you know, taxes, accounting, finance, forecasting, financial strategy, planning, and budgeting. And so it becomes a very daunting task. As Anthony mentioned, we are an outsourced finance company. So you all, most of you will be techies, I assume, technology people. So you're focused on your technology development, but you need CFO, accounting, finance work done. But because it's a smaller company, you don't need them on a full-time basis. So you also said to us, and we take care of all your financial needs, from taxes to valuations to accounts payable, receivable, forecasting, 409 evaluations, and we are we control 18% of the venture-backed companies in the Silicon Valley. So we have a pretty good chunk of market share in the Silicon Valley. Wow. Okay, so here's a quotation from Guy Kawasaki. Here's the book. And I recommend everybody to read this, The Art of the Start 2.0. And he's saying the point of financial projections is to tell a story with numbers. So you have put together a business plan, you have executive summary, and you talk about how your technology is going to become most famous in the world. But then, along with that, you need to associate all that with numbers and tell a story in a framework of numbers. So investors or whoever else, you yourself can understand it properly and make it interesting. And at the end of the day, it's all about numbers. Okay. Okay, so today's key objectives here is not to really get down into the nitty-gritty of financial models or spreadsheets, but just to create a mindset of you know, how the things should be all put together in terms of finance. Okay, so first of all, you need to have major milestones written down, and what do you want to achieve a year from now, 2 years from now, and what kind of business you want to be in, and how big you want to become, and all that. And you also, in the beginning, it may be just you and your other co-founder, and you have some ideas, and you want to achieve something. But as you bring in a couple more guys, 3 or 4 more guys, you need to get their buy-in into your objectives as well, because everybody has to be on the same page so you can move your train forward properly. Otherwise, if they're not all bought into your vision, then things are not going to move properly. So your objectives have to, you know, it's a common sense, nothing new, you all know that. You know, your other leaders have to have the buy-in to that. Okay. Okay, spending by department. What resources does each department need to hit objectives and milestones? So here, you know, you will have departments, engineering department, legal department, R&D department, so forth, marketing department, sales department. You have to create budgets with departments and with their objectives. Okay, so you in a startup company, the highest expense is staffing. So you have to have staffing plan, then I'll have 3 people, then 5 people, and then associated with that, some budget numbers. It's going to cost me so much money first 3 months, and then I'll hire more next 3 months, and so forth, right? Professional services, you would have, legal, accounting and finance, and so forth. Then contracts and consultants here, you would hire some software developer outside of your company, outside of this country, whatever. You need to have budgets for that. You need to budget for the tools, the licensing tools that you have for software development, and so forth. Then you have travel and entertainment and marketing. Any question? We can keep it interactive. If you have any question, please, or if you have something to add, please go ahead, okay? Yeah. All right, revenue, then you start with the revenue. And remember now, we're kind of going through this financial modeling plan, okay? So how do we build a financial model? And that's what we're moving towards. So revenue is the most difficult element of any business. How do you really project your revenue? You cannot just pick a number from thin air and say, okay, I'm going to be $100 million company next year or 2 years from now. So you have to make a lot of assumptions. So first of all, do not assume growth based on percentage. So if you're in a market and say, okay, this market is a $100 million market, and I'm going to capture 5% of the market in year 1. So my revenue will be 5%. Well, it's okay in the beginning just for the exercise purposes, but when you go for fundraising, nobody's going to buy that, okay? So you have to understand the revenue drivers. Investors also look at the drivers more so than actual revenue numbers. So what is driving it? So for example, for hospitals, what is driving their revenue? Sick people, right? If there are no sick people in town, the hospitals will be empty, right? So whatever business you're in, who's going to buy your product and why? What is driving your business? The money is not just falling automatically. Something has to happen. The need has to be there, and therefore you have your revenue. And then if you're already along the line in progress, you can see that, okay, if I have so many salespeople, I have so many dollars or so many customers, and if I add 3 more sales guys, then each sales guy is bringing at least 2 deals a month. So if I add 3 more, then I have 6 more, and so on and so forth. So you have some idea. You can do it that way. Basically, whatever I'm telling you is nothing really, rocket science or new. It's all common sense. It's just pulling it together in a proper manner, where you can tell your story with numbers properly. Okay. So now that you're ready with all those information, now you have to organize it in a proper manner. Okay. So Google spreadsheets are used very commonly, and Excel is also used, and there are a lot of other tools coming up just about every day these days. And basically, if you just stick with Excel, it's pretty good, So you create a separate worksheet for revenue. You have a revenue worksheet, and then you have expense worksheet. And for expense also, as we talked about, you need to have it by department. And then in the end, you roll up everything and bring it together. And then along with creating your revenue and expense spreadsheet, you are basing all that based on some assumptions. And you need to write down all those assumptions, because after a few days, you'll forget why you put that number. And you say, okay, that was based on the assumption that the economy will be really hot, or something will be happening in the marketplace that my product will become hot, or whatever the case may be. Or I will be ready with my product, or I have so many engineers, so my product will be ready by the end of 6 months, and you don't have that many engineers hired, and therefore you couldn't develop that product on time, or whatever the case may be. So you need to write down those assumptions. Okay, so here is a key assumptions worksheet. So typically, people have 5 to 10 key assumptions, and too many assumptions are also not good. Just stick to the basic. And examples of key assumptions are, how fast are you going to hire your people? Will you be able to find the people you're looking for? If you're getting into the revenue phase, you you look at, one salesperson, as we talked earlier, one salesperson is bringing us so many customers, closing so many deals. So how many salesperson we need to hire to get up to that level of sales? And then if you're in a SaaS-based model, what is the lifetime value of the customer? What is the churn rate? How fast the customer is falling off, or how long customer stays with you and then he falls off, and then you have to bring. Like Uber, I was watching Uber's earnings yesterday on TV. They were saying that out of every 100 drivers, there's 6 to 9 drivers falling off every month. So they need to go bring more people on the road, otherwise the service will be compromised. Okay, now that we are ready with all that, we start putting a financial plan together, a budget together. So first we have to identify the key variables. What are the, if something happens, something else happens. If the economy goes down, my revenue will go down by 20%. If the economy is hot, my revenue could go up to 20%. If I don't have my product ready, I'll be missing out, or some competition is coming. So all those things that are affecting, those are all your variables. Identify your key revenue assumptions. We talked about that earlier. What are those? And then run different scenarios. Run what ifs, sensitivity analysis. If the economy is up, I will do better. If the economy is down, my sales will go down. Or if you're in product development, if I find enough engineers, I can develop my product faster. If I don't find enough, then it will delay, right? And then you do a forecast on a 3-year plan at the most. Nobody wants to see too long-term planning. Just 3 years is good enough. Okay, now that we're ready with all that, we're ready to go for fundraising. How many people have raised any money yet so far? Yeah, that's good. So you already have been through that. Fundraising, remember, it's not just raising money to do your project or product development and run the business. It also is raising your valuation of your company. So if you're raising some money, after first round, it's worth a lot more than what it was before, hopefully. Okay, unless you're really not achieving your milestones and not delivering what you had promised or what you had anticipated. So,
can I ask, this is targeted at which round of fundraising?
This is Series A or even before. It doesn't matter.
Got it.
Anytime, anytime. Okay. Yeah. So anytime you take money, unless it's convertible or something like that, we have a different presentation for that.
Right.
But whoever is investing money, they want to know at what price I'm buying this share, right? And so, and then when you go for the next round, hopefully now you have achieved more milestones, and you have a product that is getting closer to market or already in the market, or you have first customers, so the value of your company is moving along with that. Right? So fundraising is that also. It basically is that. And then how do you list out all the objectives, right? So along with all your objectives, you have a budget associated with that, or a dollar figure associated with that. So, for example, your milestone will be gaining customer traction or building a product. So you say, okay, in 6 months, I'll have my product ready, or at least one feature of my product ready, and then in the 6th month, I'll have a first customer signed up for beta or whatever. So at least now you have moved on from nothing to something, and then your valuation is a lot more than that. Okay. Then you evaluate how much time, resources, funds are needed to achieve that goal. And that comes with the overall budget. I'll have 10 people, so I'll need a bigger office space and more software tools, licenses, and so forth. So you budget all that. And then in the end, you give yourself some buffer also. 20 to 25% extra money, and this is very tricky. Sometimes you may think that if I ask for more money, the investor will say, he's trying to just rip me off, or just bluffing. Or and if you don't get enough money, then you run out of money sooner. So you have to be. By the way, I didn't introduce myself in the beginning properly. So prior to early growth, I have started 2 companies. One company, I took it public from scratch all the way. And then later on, it got sold to a Japanese company, Takara Biosystem. It was in the biotech space. And then I started a clean energy company, which unfortunately didn't go well. So we shut it down after 3 years, and we spent time and energy and effort. But we learned a lot. I learned more in the failure company than I learned in the successful company, because something called luck was also in our favor in the first company. Whatever we were doing, whoever we were talking, everything was yes, 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 and okay, okay, okay. So there was no rejection, turned down, kicked around like football, anything like that. So in the second one, there was all that was happening, and we faced the reality, and you learn a lot.
What was your clean energy company?
Yes, it was a clean energy.
No, what were you doing?
So we were we were going to make hydrogen and oxygen gas from solar energy. And it was electrolysis process in a way, but instead of using electricity, we were using heat directly from the solar energy. And it just, it was taking longer. We were using a catalyst called ferric oxide in that. And everything was going well except for the yield, which was not coming to the point where it would justify cost-wise. And that's where we went.
What's the first startup?
First one was biotech. It was DNA analytics. Do you know about PCR, polymerase chain reaction? So we had a chip that was doing high throughput qPCR. So more reactions, 5,000 reactions in 1 hour, as opposed to that same thing would take you 1 hour to do it manually with pipette. And that was our. Okay, then you need to do some trade-offs after completing a budget. As to, if I don't finish, if I don't get to my milestone, what will happen? If I reach a lower milestone, then what is a give and take here? Sometimes you're going after $10 million and you get $6 million. So what can I do with $6 million? I have to compromise with, instead of 5 features, I'm going to make 3 features in my software, and then the other features will be add-on later on when I'm in the business, right? And then what are the key expenditures for each department? Once again, you go through your sales, engineering, legal, accounting, finance, each department, what will it cost each month? And that's what we do. We do planning and budgeting and forecasting in details, so that you can have a good forecasting for the whole year or for the whole 3 years, which is needed when you go for fundraising. And then not only for fundraising, but for your own business also, you need to see how you're moving along. What is your progress report? It's your report card for yourself, whether you're meeting the objectives or you're beating the objectives or you're behind. And then where you're behind, you fix it quickly, and if you're ahead, you keep doing what you're doing more. And that's what it is. Right.
So I'm kind of curious, in telling the story that you want to tell as part of a fundraising diligence check, that's probably when this stuff would come up.
This is the financial piece of it only. Yeah, remember. Not technology, not anything else.
I'm curious, projections depend on assumptions. Assumptions have a range of what's realistic and what's not. Mm-hmm. In what you send to investors, how do you recommend balancing the trade-off of where in the range of reality you populate?
Well, you have to use your common sense along with your team members, brainstorm and challenge each other before you send it out. So does this assumption sound ridiculous, or is something of real? And you do a litmus test amongst yourselves first. If somebody's laughing at it, then don't send it out. Mm-hmm. And then if your own team member doesn't buy in, then outsiders won't buy in either. So you have to be really realistic about what you're putting down, and do some homework and see the scenario out there. What kind of competition is out there, what kind of market is out there. You cannot just assume everything glory in your own head. You have to be realistic about it, and that's all it is. And then when you get challenged, you have done enough homework, and you have poked holes yourselves amongst each other before getting there, so it's more bulletproof. You are confidently answering and satisfying the questions they have or the challenges they're making on your assumptions. Yeah.
I'm sorry to throw a follow-up at you.
Sure.
Many businesses execute in phases. right? So like you launch one product line and you use the revenue of that to launch another, or
Yes.
whatever it may be. And in trying to tell a story for an investor, obviously one of your objectives is, hey, this is got clear potential to be a high growth venture. Pick your favorite number, $100 million company, whatever it may be. So is there giving the example of businesses happen in phases, you can shoot for a $100 million target if you're saying, oh, I'm going to execute these phases faster, if it falls into the realm of reality for hiring, of course. But I guess the real question I'm asking is are there threshold 3-year projections under which we should sort of correct to say, well, maybe we should use more aggressive assumptions?
Well, it all depends on the product, on the market you're in, on the business you are, If you're a SaaS-based business, there's different kind of scenarios. If you're a manufacturing guy, it's a different scenario. So it depends upon, what industry, what business you're in, and then you can look at some examples that are out there and then kind of use that as a benchmark, right? But 3-year plan is the best way, because you can if you're confident about your long-term plan, you can put a long-term plan also. But investors usually want to see, how fast can I get my money out, or are they going to perform? First of all, are they going to deliver what they're promising in a year or 2 or 3, And when things are progressing well, then they're more confident and they want to move along with you further. So initially, nobody's going to say, okay, it's a 10-year deal, put the $100 million right off the bat, and then you don't know, next year all the team is collapsing, fighting with each other, gone, So it's very difficult. Unless you've been around for a while, you've raised a few rounds, then you solidify. Like Uber is solidified now, So when you establish your business, then then people are standing in line to give you money rather than you going to them to ask for money,
Thank you.
But initially, this is for really early stage companies that we're talking about, when when you have no money or just little money in the bank, actually. Okay, things always change. So basically, your forecast, as I mentioned earlier, is a 3 years forecast. So you have to stay on top of your forecast. So if this is Q4 right now, you have a forecast for next year and the year after and the year after, and then in Q1 of next year you will again have following 3 years forecast. So it's an evolving thing, and you need to keep it updated, because whatever you have in the second year forecast right now today may change it in February and March, right? So it's an evolving thing. You have to keep it updated. And then lastly, cash burn and amount of next raise. This is the most important thing for a startup company. Cash is king. Okay, you can delay your payment to your landlord, your lawyers, or anybody if you're running short of money. But if the money is out of your account and you have zero money, you're gone. You're going home. That's it. But if you have cash in the bank, then you're still alive and you can do a lot of things. You can raise more money. You can do a lot of things, right? So cash is very important to keep track of cash, preserve cash, and look at your runway. How much cash do I have? 6 months worth, 1 year worth, 3 months, and then take action accordingly. Go out and raise more money, or do something, talk to somebody, and delay your payment with people you can, negotiate terms, all that, But if you run out of cash, it's over, right? Okay, trend analysis. We talked about it's a historic trend, prior year revenue and spending. If you are already in revenue, then you look at last year I was doing, Q1 was like this and Q2 was like that. This year.
Can we go back to the last slide? I'm sorry to keep.
I like it. I appreciate it actually.
On that last point, one way of figuring out how much to raise is based on figuring out how much runway you want to establish for your venture. I suppose another way is, what do I want to grow to, and what money do I need to achieve that? Are there other ways to look at how much you should ask for?
Well, whatever you asked for in the previous slide, you saw 20 to 25% buffer, right? So if you want to raise, if you need $10 million, you would be better off raising $12 million or so, $12.5 million. So $2.5 million is like a something you guys never thought of, right? Your team didn't think of, or some unknown happens out there, some unknown circumstances, or something can happen. So it's good to have some buffer. There could be a time if the whole market crashes, no VC will invest anything for a while. They all become tight and conservative. And then what do you do then in the meanwhile? Do you continue, if you have money in the bank, you will continue to do your work, develop your product, or keep on pushing your company forward? But if you are coming to an end and there is nobody willing to put some more money, then it's going to be not very pleasurable, right? Did I answer your question?
Not really. I mean, I do agree that it's nice to add a buffer to whatever your target X is. My real question is, do you have suggestions on the ways you should go about figuring out what X is?
Well, that's you do your I'll get to the next slide. It's a bottoms up. There's a top down budget and there's a bottom up budget. Okay. So okay, here's the top down and the bottom up.
Just so, can you just give us just a basic overview of what, when you say financial projections, right? What are the documents or the pieces of information you need? So,
okay, so for example, software development, okay, and you have 5 features of it.
No. I'm just saying even at a higher level than that. Just if you're
you can summarize.
You need a budget, right?
Yeah.
You need what else? So you need a budget. You need, I guess, like revenue projections. What are the different?
Yeah, revenue projection is part of the budget actually.
I see. So the budget is the one overriding thing.
Anything that has to do with dollars and cents, it's all in financial planning, and your forecasting, your budgeting, your revenue, your expenses, you're all in there. Okay, and you can. Investors will do their own IRR and discounted cash flow analysis and payback and all that. That's up to their. They will think they will determine. If I make so much investment, and that's a different class altogether. How much return will I get? What kind of exit will I have? This particular one is like, how do you put together the money that you will need to move your business forward?
I'm just saying, if you're going to do the financial due diligence, what are they going to expect to see?
They're going to expect to see the budget, exactly.
Got it. That's one document, and that includes your...
I hope to God that we're not sending the... I don't think we send the budget out. I think that there's strong alchemist advice against doing that.
Sending the budget.
But I've seen people
recommend... send out meaning, okay, so send out...
That's my question.
Send out is like, okay, initially, in the PowerPoint, there's only one slide that is a very high level, 5-line numbers. That is not... then when they do due diligence, when they're ready to invest money, they will go to nitty-gritty. How did you come up with $2 million? Show me the details behind it. You cannot just throw in a number, $2 million, say, okay, I'm going to hire 20 engineers. Each engineer is $100,000. Therefore, it's $2 million for engineers times 20% burden, so $2.4 million. So here it is. And one engineer is going to work on this and that and that. So when they get serious, they will get into due diligence and they want to see the detail. So the number you will put on that slide should actually roll up from all these into that summary. And that summary, behind that summary, you should have the details properly. All the assumptions, okay, I'm assuming I'm going to rent a place for $5,000 a month. And if you end up renting in San Francisco for $10,000 a month, then your assumption, so we are assumed this much, so, you know where you went wrong or what happened,
And at the financial due diligence stage, they're going to ask to see all of this documentation?
Some, it all depends on the investor. Some want to go into nitty-gritty of all the things, and some will say, okay, I like the story, there's the money, get going. I don't know, it's all, but it's good for your own sake also to run the business. You have budgeted yourself, right? That I'm going to spend so much on rent, so much on engineers. It's for you also.
No, I get it. Yeah. But I'm just saying on the narrow question of financial due diligence.
Yeah.
They at least they might ask for.
Yeah, and they will check the bank account, and you have to be prepared, and it depends on what kind of guys are on the other side of the table. They want to go into nitty-gritty too much or little. From what I heard, Mark Zuckerberg was sitting with this guy, I forgot his name, the first guy, the Hungarian investor, and he gave him $1.5 million, and he was 20 years old, so he had to order a 7-Up to celebrate